Hello everyone, and welcome to Think in Financial English. In this first lesson, we are going to answer one basic but powerful question: how does the financial world actually work? Finance can look complicated from the outside. You see banks, stock exchanges, interest rates, central banks, and financial headlines moving every minute. But underneath all of that complexity, finance begins with one simple movement: money moves from where it is saved to where it is needed. In professional finance, we often describe this movement using two groups. On one side, there are surplus units. These are households, companies, pension funds, or institutions that have more money than they need to spend today. On the other side, there are deficit units. These are companies, entrepreneurs, governments, or households that need capital now to invest, build, expand, or purchase something. Finance exists because these two groups need to find each other. In theory, a saver could lend directly to a company. In reality, that is difficult. A single saver may have only $10,000, while a factory may need $10 million. The saver may want the money back next month, while the factory needs funding for 5 years. The saver may not know how to judge whether the borrower can repay. This is the matching problem at the heart of finance: different sizes, different time horizons, and different levels of risk. This is where financial intermediation comes in. A commercial bank acts as an intermediary. It collects many small deposits and pools them into a large source of funding. It then lends that funding to borrowers who can use it productively. The bank also performs risk transformation. It evaluates the borrower, prices the loan, requires collateral when necessary, and monitors repayment. Finally, the bank performs maturity transformation. Depositors may want short-term access to cash, but borrowers often need long-term loans. The bank manages that timing gap. Banks are not the only channel. Large companies can also raise capital through capital markets. They can issue shares in the stock market or issue bonds in the debt market. In the United States, many large firms rely heavily on capital markets. In Taiwan, traditional banking and financial holding companies still play a very important role, especially for small and medium-sized enterprises. So when we say capital flows, we are talking about both bank-based finance and market-based finance. Now we need a second key idea: liquidity. Liquidity means how quickly an asset can be turned into cash without a major loss of value. Cash is the most liquid asset because you can use it immediately. A listed blue-chip stock is relatively liquid because there is usually a buyer. A factory, a private company stake, or a luxury office building is much less liquid. It may be valuable on paper, but it can take months to sell. That is why people can be asset-rich but liquidity-poor. Liquidity matters because banks live with a permanent liquidity gap. You can withdraw your deposit at any time, but the bank may have used part of that money to fund a 30-year mortgage or a 5-year business loan. If too many depositors ask for cash at the same time, and the bank cannot liquidate assets quickly enough, a liquidity crisis can begin. This is why confidence is so important in banking. A bank is not only a balance sheet, it is also a trust mechanism. So who controls the tap? That is the role of the central bank. In the United States, it is the Federal Reserve. In Taiwan, it is the Central Bank of the Republic of China, Taiwan. Central banks influence liquidity by adjusting interest rates and managing the money supply. When they raise rates, borrowing becomes more expensive, credit growth slows, and liquidity tightens. When they lower rates, borrowing becomes cheaper, investment becomes easier, and liquidity loosens. Taiwan is a useful case because its financial system is deeply connected to global trade and technology. Exporters care about exchange rates. Manufacturers care about credit conditions. Banks care about liquidity and regulatory stability. Taiwan Central Bank is often described as cautious and measured. That does not mean nothing changes. It means the system often prefers gradual adjustments rather than dramatic shocks. For finance professionals, this creates a relatively predictable but tightly managed environment. Now let us upgrade the language. In financial English, do not rely only on up and down. If a market rises sharply, it rallies or soars. If it falls sharply, it plunges or plummets. If it moves unpredictably, it fluctuates. If growth stops and becomes flat, it plateaus. If liquidity becomes harder to find, we say liquidity tightens. If credit becomes easier to obtain, we say credit expands. These verbs let you describe market movement with precision and confidence. Here are 3 sentence patterns you should master. First, capital flows from A to B. For example, capital flows from households to businesses through the banking system. Second, X provides funding for Y. For example, commercial banks provide funding for corporate expansion. Third, when X happens, Y tightens or loosens. For example, when the central bank raises rates, liquidity usually tightens. These patterns help you explain finance like a professional, not just translate words one by one. Let us apply this to a mini case. Imagine a Taiwanese electronics supplier needs a short-term loan to buy components before the export season. At the same time, the central bank raises interest rates to control inflation. What happens? The company's borrowing cost rises. The bank becomes more selective. Credit conditions tighten. If the company is strong, it may still receive funding, but at a higher price. If the company is weak, it may have to delay investment or reduce inventory. Your task is to explain the financial system in 4 sentences. Use the words flow, intermediary, liquidity, and tighten. You can say, a capital flows from surplus units to deficit units. Banks act as intermediaries by pooling deposits and providing loans. Liquidity measures how quickly assets can become cash. When interest rates rise, liquidity may tighten and borrowing may slow. If you can say these 4 sentences clearly, you already understand the foundation of this course. Today, we built the map of the financial world. We learned how capital flows, why banks exist, how liquidity works, and how central banks influence the system. In the next lesson, we will meet the people and institutions inside this system: commercial banks, investment banks, asset managers, insurers, and financial holding companies. Once you know the flow, you can understand the players. I will see you in Lesson 02.